And we will be joined with Gene Pastula coming up in just a bit, certified financial planner who knows a lot about what I'm about to tell you. This just happened, by the way, in the last month or so, couple months. In August, the University of Michigan announced that it amended its contract with its head football coach Jim Harbaugh, to include a very creative deferred compensation alternative, which involves cash value life insurance. And you've heard me and Gene Pastula talk about this as an alternative savings medium for regular folk, but even a huge deferred comp for Harbaugh. Let me tell you a little bit about it, because it's designed to create a tax-free income for Mr. Harbaugh some years in the future. Here's what the article says. Instead of a deferred compensation arrangement, Harbaugh and Michigan entered into a split dollar loan agreement under which the university agreed to make 7 loan advances of $2 million each that would be used by Harbaugh to pay premiums on a life insurance policy. As long as the policy remains in force, the loan will not have to be repaid until Harbaugh dies, at which time Michigan will recoup its original $14 million investment. His family heirs will receive whatever's left over. So far, what's the risk for the University of Michigan? They're getting all their money back. This is why deferred comp plans all across America usually include a life insurance policy, and why you might want to consider this. Now, the loan agreement allows Harbaugh to borrow money out tax-free as long as the policy continues to meet certain sustainability requirements. So let's get into this, because from at least our perspective, you should know the following facts. And then I'm going to ask Gene Pastula to comment on them. Assuming Harbaugh qualifies for preferred medical underwriting, he could get a policy with an initial death benefit, check this out, of $35.6 million, which could grow to almost $50 million by the time all the premiums had been paid. Then this firm that's doing the projections, Schechter Wealth, projected that he could begin taking, you might want to write this down, $1.4 million per year out of the policy, income tax-free, beginning at his age 66 and continuing all the way through age 98 if he lives that long. At the same time, his heirs would receive a residual death benefit that could reach as high as $35 million, but once he starts taking the income out, it could go down as low as $1.3 million or $1.4 million at age 98. 66, 76, 86, 96, now it's 42 years of income, $1.4 million tax-free for a $12 million investment. Crazy, isn't it? And by the way, one might ask, well, what about the taxes that Harbaugh has to pay? Isn't he getting a gift, or isn't he? No, on a split dollar arrangement, which I'm not going to get into, it's pretty technical. But on a split dollar arrangement, he pays tax on an imputed loan. It's tantamount to them saying, we're going to charge you this income tax as if you borrowed the money, but we're putting the money in the policy for you. And that tax would cost him somewhere in the neighborhood of $120,000, $150,000 over the next umpteen gajillion years, 7 years. That's all. That is all. This is why so many businesses use cash value life insurance. My question to Gene Pastula, as we welcome him on this show again, is, Gene, if this is good for the University of Michigan and good for Jim Harbaugh as a retirement plan, I understand the numbers are really, really big and the average person can't relate to them. But it does illustrate the point that this can also be good for our viewers and our listeners out there. What say you?
Yeah, well, it's interesting. Rich people get all the breaks, right?
Yeah.
That's a classic example of what insurance can do. But it combines two things there. One is obviously the complexity of insurance, and two, the fact that you're using numbers that are in fact huge. But the ratios are basically are accurate, and it is an incredible opportunity for people who are willing to explore things other than banks, bonds, and stocks as a way of accumulating money for retirement. Now, I have something a little bit more modest sitting in front of me here that I just did for a client a couple of weeks ago. A young man who isn't particularly rich or anything else, but he wanted to start building a retirement plan, and he had $1,000 a year that he wanted to put aside. And of course, where's he going to do with that? Bank account, stockbroker won't even talk to him, and his options are really very small until you start looking at insurance. And we set up a plan for him where he puts $1,000 a year. Now, he's in his middle 30s. He's just a young guy. He's got a lot of room in front of him. But he puts $1,000 a year into this thing until he's ready to retire in his middle 60s, so about 30 years. So he's going to put $30,000 into this thing, and at just looking at the results that would have been received in terms of rate of return and what have you over the past 20 years, and projecting that same level of results into the next 20 or 30 years, he can expect to get somewhere around $13,000 a year for the rest of his life, all tax-free. A 13-to-1 ratio. Now, obviously, over time, the individual is probably going to be able to add to that and put $2,000 a month or $5,000, a year, or $5,000 a year into the policy. And now you're looking at $60,000, $70,000, $80,000 of tax-free income for the rest of his life. Might it be $45,000 or $50,000? Could it be $80,000 or $90,000? That all depends on how the economy goes over those years.
All right, we're going to take a quick break on that, Gino. Hang on a second. We got to take a hard break here. We'll come back and talk about this. Is a life insurance policy a reasonable alternative or a reasonable supplemental retirement income? That's the discussion when we come back with Gene Pastula, certified financial planner. It certainly seems to be working quite well for none other than the head coach of the University of Michigan, Jim Harbaugh, who, as we just pointed out, is going to get a humongous retirement benefit that pays him a tax-free income. We'll be back.